Leverage ratios are often considered when analyzing fundamental data for a company. They usually consider the liquidity or bill-paying ability of the company. Low liquidity can be a signal of bankruptcy. Leverage ratios vary immensely across industries, so comparisons should be done to peers within the industry. The use of debt and equity are financing decisions that every company must make. Market and economic conditions affect the decisions as each funding source is associated with risks and costs. Total debt to total equity ratio compares total debt to total equity from the latest balance sheet. Total debt includes both short-term and long-term obligations. Lower is typically better as it implies there is less of a debt burden on the company. For example, a company with $10 million in total debt and $50 million in total equity would have a total debt to total equity ratio of 20%. A company with the same level of total debt but only $25 million in total equity would have a higher ratio of 40%. The first company has less debt in their capital structure and possibly less risk to equity investors. Advantages of leverage ratios are that they are easy to compute and to understand. The ratios give valuable information about a company's operations. Disadvantages include that ratios are not comparable across industries, which can make evaluating the companies very difficult. The general trend in a ratio over time is informative. Falling leverage ratios may imply that a company's liquidity is declining or may hold other information about a company's cash management and debt levels. Viewing the components of each ratio separately can be helpful as well. If the total debt to total equity ratio is falling, is this caused by a decrease in total debt or an increase in common equity? Or could it be a combination of both? In this example, ConAgra's total debt to common equity ratio ran about 75% in 2005 to 2012, then shot up to over 200% in 2013. Since then, the ratio has declined to a current level of 153% of equity. A lower leverage ratio is preferred, though often many industries use debt heavily. Less debt might mean a stronger balance sheet, less risk to equity investors, less leverage, and more liquidity. More debt might mean more profitability. It might be wise to view the financial statements and filing to see why debt has increased or equity has decreased in 2013.